Hello, this is Compound Interest Stock Guy, and today we're going to be talking about options in cannabis stocks. So stay tuned. If you're new to the channel, please subscribe, hit the bell notification down below so you're notified when I upload a video. Please give me a thumbs up. If you like the video, give me a thumbs down if you dislike the video. And I also want to disclose I'm not a financial advisor. This is just for entertainment information purposes. Do not buy or sell based on anything I talk about in this video. Buy or sell after you did your research and your due diligence and you like the investment you're pursuing. So I'm going to get into the pros and cons. That's what this video is going to be about. It's going to be called the pros and cons of cannabis investing. So basically, cannabis investing in options, I mean. So basically, with options, you can do calls or you can do puts, and I'm just going to kind of explain it. I'm not going to go to the option chain on my web broker to explain it, but I'm going to just try to explain it by looking at the charts. Okay, so first we're going to look at Village Farms, and so not every company in order to play options you need to have a margin account. So you have to apply for a margin account with your broker, and then you can start playing with options. Now, if you have, say, like $100,000, you have $50,000 or $20,000 that you're investing into regular stocks, then you don't want to play the same game with options unless you're selling calls, and I'll get into that later. But if you're buying puts or buying calls, you really want to only play with maybe like 2 to 4% of the same amount of money that you'd be playing with your own investment account. And the reason is you can lose your money really quick, and it's very speculative, and it's you're gonna lose a lot more of your trades than just regular trading, and that's one of the cons with doing options. Buying calls and puts is your win ratio is gonna get killed. You're gonna not win as many trades, uh, and if you don't have much time, you're gonna lose like your money like really fast. And that has to do with theta decay. But I'm going to try to explain in the purest form about where it can be a good tool to use in real world situations. So let's get into this. So Village Farms. So if Village Farms was on I don't remember the date it got onto the NASDAQ, but as soon as it gets onto the NASDAQ, uh, that's like maybe a few days later or a couple weeks later, that's when you are able to buy calls and puts in Village Farms. So say like right here, and I don't have the analysis like the real time to prove how much an option would cost, but I'm gonna estimate uh, generally how much it might cost depending on the time and the price. So say, and that's what you have to do because the price changes all the time. You don't want to pay much money for an options because then it gives you a lot more. I mean, if you have a lot of time, then it's okay to pay a decent amount of money for one, but I'm going to get into that later. But basically here, if you were able to trade an option and buy a call right here, so at 839 USD, and you are really bullish and you didn't have much money in your trading account, but you wanted to play the upside leverage of Village Farms without buying, say, like, because if you buy one contract, it's 100 shares. So if you were to buy 100 shares, this would be almost $900 US. So in order to buy, if you were right looking down here and you wanted to buy the option for $9, it will give you the option to buy at the time of the expiration, or you can just sell it if you're in the money. So say you buy it here and you buy one for a month, and say you pay 20 to 40 cents per share. That would be like $20 to $40 plus commissions. And then you say it goes, it was February 20th, and then March 20th it's going to be $16. So you paid 20 to 40 cents, and in that time, because the price went up so much, it ended up being worth so much more. It ended up being worth around $7 per share, and per contract it'd be worth about $700. Uh, and you paid 20 to $40 plus commissions. So, I mean, I don't know, that it could have been a lot more expensive. It could have been maybe 60 to 90 cents maybe for that contract. It really depends how the market makers decide how they want to do it. But if you found that it was going to be, you felt it was really bullish and you felt that the risk reward was good, that is when you would want to do that. Because say you bought 2 or 3 calls at this price, and when it was here for like 50 cents maybe, and for a month, and you turn it into to $7 US dollars on that, that would turn into like from $150 into like 1,500 to $2,000. So you made a lot of profit without, and if you were to buy the amount of shares, you would have paid like $2,700. And so, and the thing you have to worry about is selling before the expiration. And if you wanted to buy the shares and it was here, you wanted to have them for long term, when you're in the money, it gives you, if you don't sell, you can uh, call your broker and convert it into shares, and that costs like $30 depending on your broker, but that's what you could do. And so without spending a lot of money, you could have made a lot of money. Now, when it went to $17, you could have said, I think that it's going to go down to $13. So you could have bought a $16 put, and maybe that for a month, and maybe that cost you 50 cents or 30 cents. And as long as it goes below $16, you're going to make a lot of money. It doesn't even need to get to below $16. If you bought it at 17.45 and it starts getting really close to that money, your premium for the option contract will go up. So you can just sell it to the market and make money. That's the same with when you do this call. And even if it doesn't hit $9, if you bought at $6, you bought a $9 strike, and it gets to like $8, and there's still a lot of time on the contract, you can sell that and make like 100 to 200% sometimes. So you don't need to worry about keeping the contract till expiration or anything like that. But I mean, it gets pretty advanced, but I'm just want to try to make it as simple. And that's that's one of the reasons why I don't think a lot of people want to try options, because it's extremely challenging, and it's a lot of mental brain work to analyze these things. And this is just the basics of options trading. So you can get a lot more intense, but which is why the mass majority of folks just want to buy this at $6 or $7 and let it go to 14, $15 and sell out, which is a great idea to do. And you don't need to worry. The thing about owning the shares is you don't have to worry about time. When you buy option contracts, you're paying for time, and the strike price. So if the closer it gets to the expiration, the lower the value of the premium for the time. So it's like an addition thing. Like you have uh the close to the strike price, and there's also the time, and you add those together, and that's how much you're and then there can be implied volatility, and that gets a little more advanced. But those are the things that play into effect with how much your contract should generally be worth. And there's no exact science to this. It's a game of feel. It's almost like chipping or putting if you're a golfer. That's a good analogy. Or like taking free throw shots with as a basketball player, or just making a layup. Like it's a little bit of feel to get it in, and sometimes you're gonna miss your chips and your putts, but you're gonna get close, and it's a feel thing. That's what I think is the best way to explain it. But here we're gonna do the next chart for Tilray, and Tilray people could have made money hand over fist. I'm talking hand over fist on the options. But at the same time, don't get too greedy with all this thinking and thinking that it's so easy, because the market makers will make it difficult. Because so you think, okay, I'm just gonna buy like $2,000 worth of put contracts right here at the top. Well, when it hits that high, those contracts, say you could buy a contract for 150, 150 put or 100 put, they're going to be extremely expensive because of the volatility, the IV, the implied volatility. Or say it's like right around here, and then the market thinks that it's, and you do a call, so you do 100 call, you're going to pay a lot of money. So you need to do your assessment to realize, with your charting, to realize that, and your fundamentals to realize that it's going to go up a lot in a short amount of time. Or if you have a lot of time on the expiration, you're going to pay even more amount of money. But yeah, so but for example, if when it IPO'd, it was out here, and then it started like just chilling around here. And then usually it takes a week or 2 weeks before you can trade these options. So say you were really long, and you think that Tilray was going to go to $50 plus easy. So you wanted, say, a 3 month call. So somewhere around to November-ish to December, around September-ish. Uh, yeah, maybe August, I guess, mid-August, somewhere right there. And you say, okay, you're going to pay for each contract, gives you the option to buy at $50 until November, December. So depending how much it costs, maybe it was $1 or $1.50. I'm just doing estimations. I don't know the exacts. And that's really what you have to be aware if you want to be a good options trader, which I don't even call myself a good options trader, which I've learned a lot, and I'm okay. But to be profitable as an options trader, you need to be like advanced, and you need to be like really good. So it's definitely a hard skill, and I don't think that it's right for everybody. But certain parts of options can be beneficial if they learn, for anybody, I think, and I'll get into that later. But basically, okay, so you do this, and actually, no, I'll do another series and talk about the selling calls, but we'll talk about just basics for this one. And so if you paid, like, say you bought 3 or 4 contracts for $400, $500, if it was $1 per share for the contract, one contract equals 100 shares. Now, say it goes to $100, each contract's worth at least $50 plus the IV and the time. And so you could get like 70 per contract for the $50 strike, and you could sell that, and you could say, oh, okay, I'm gonna sell those out, and then you're gonna play a higher strike. You're gonna play like a 150, which is less money, and you're taking money off the table. So say you're up like 40 times or 30 times on your position because you just made a lot of money and you just killed it. Um, then you'd pay less money for this contract, and uh, so you would pay, instead of paying like say 50, $65 for a $50 strike, you'd when it was at around $100, you would pay maybe like $1 or $2 or $3 per contract. So you're taking a lot of money off the table and you're taking out the risk. You're not going to be able to make that contract worth as much money, but you can play the upside and eliminate the downside of the trade going against you because you're taking money off the table. So that's a way to go, and it can get intense into different ways of going about it. But then now you want to play the put side on Tilray. So say it's at 225 and you think it's going to go to 150. You pay say like $2 or maybe $5 for like a 1 month or 2 month contract. It just depends how much they're worth, and you got to figure out the risk reward. You have to assess that and realize if it's going to be a good risk reward, because that's basically what, when you're buying calls and puts, you're assessing if it has a good risk reward. Because if it's not a good risk reward, then your probability's off, and you want your probabilities to be like really high, so that you're giving yourself the benefit of the doubt to beat the market. So so yeah, you're like 150 when it's two, and so now it goes to $100 and you paid say $3 to $5, and then you turn that into $50 or maybe $60 when it goes down to the bottom. So you sell out of that and you still think it can go down below that. So you sell out that, and now you get a $50 put and you pay $3 or $4, and you eliminate a lot of the risk on it going back up and losing that money. So that is what you can do, and this is where options can pay an arm and a leg. Now, with options with Tilray, because it's been down so long, the volatility and the price per contract is very inexpensive. Now, if Tilray starts going up to $55, $65, these contracts will start going up a lot more money, because then there's going to be a lot more people betting on it going to $100, $150 a game. So that's why you want to, if you are really bullish in 2 to 3 months, then it would be smart to buy, say, like a $50 strike or a $55 strike. Buy one or two or three, or I mean, depends how big you want to go. When you're playing this game, as I said before, you want to play on a really small position. Unless you're like a millionaire, then you can buy like 10 or 15 contracts or something. But generally speaking, I think buying 1 to 3 contracts on something like this is a good way to go about. And yeah, because you always want to have cash in your position, in your margin account, so you can strike when it's right. So that if it came about and it hits there, and you think it's going to go to 150, then you could buy like a $150 strike or a $120 strike, and you could make a ton of money. But for now you're thinking about it's going to go to $100. You could buy like a 2 months. So it's May right now. You could buy it for like July or August, and when you think it's going to go to $100 or $150, and they're not going to be that expensive right now. Now, the downside of that is if it does go to $20 or $30, then the amount you paid for the contract, you're overpaying because it's gone down in that time, and you're losing time as well as the price per share. So, but now if you think that Tilray is going to go down to say $25 in the next 2 months, you could make like a 35 or a $30 strike. And if it goes below the 35 or 30 strike, or you could even do a 40 strike in that time, and you could make money as long as you didn't pay too much for the contract and all that good stuff. But yeah, that's basically with Tilray. Now I'm gonna do Zyne because I had a lot of success with Zyne, and I could have even done better with Zyne. But I'll tell you my experience with Zyne. So somebody told me when it was around here that Zyne had a $21 price target. So I did my research and I realized that they have a Zygel and they're doing clinical trials. And I have a video in my library you can check out about Zyne and the Zygel, and it's very informative. I think it's gone up a lot in the last while, so I don't know how much it's going to go up in the next while, but it does what it has going for it has a very low float. So what did I do? I bought, I think when it was at, I bought a 750 strike for say like 25 cents. I bought three of them, and these were good till like May 21st. It was like a 2 month timeline, a little over 2 months, and I paid 25 cents. Okay, so these these could have made me a lot of money if I held them the whole time, but I wasn't sure of the market and I scaled out. But I'm gonna explain how much money the potential I could have made on those is because there were 750 strikes, and so it went to for 1550. Okay, so each strike would have been worth at least like $8 when it hit that level US. So these could have been worth like $9 or $10 per contract, maybe even more depending on the IV. But basically, so I paid 25 cents per contract, and I could have 30 to like almost 40x my money in that time because I was right on my trade. But what did I do? I sold out when it went up to like somewhere around here, and I was like up like 3x my money, and then I sold, or I sold another maybe like I forget, like somewhere around here I sold out my contracts. But then what I did is I bought, what it's called is rolling over, is I bought the $10 strike. So, and these were good till like May, the end of May I think. So then I had one that I made like, I don't know, maybe like 150 bucks. And then I had another where I sold out around like here, and it was like 200 $300 out of spending maybe like, I don't know, 30 40 cents. I forget exactly the time, but I know I made money on all my trades with Zyne, because I was bullish. Now what you could do, well, uh, if you wanted to collect premiums and you own the shares, say you own, this wouldn't have been a good trade to do, but this is a good example to understand where it could be used and where it's not the best place to use it. Is basically, so you get you're owning these shares, and you're not really worried if if you lose the shares at the end of the contract. You just want to ensure that for the time being, if it goes in the money, or like um if it just below the 750, say that's what you do your sell your call your covered call at, 750 strike. As long as it's under that, then when the time, say you could do 1 month or 6 weeks to and you can collect premium. So say that same person that sold me these calls, I could have been the person selling calls, and I'd have them to back. So I would have like maybe 10, I'd have 1,000 shares, and I want to collect premium. So I'd get at least $250, and I have the 550. So the worst thing can happen is it goes below here and I didn't sell, but I still collected my premium. So I collected the $200 or so, like 20 cents, 30 cents per share on 10 contracts is around $200, $300 US. So you're going to pay commissions, and that'll get into your profits, but that's what you're dealing with. Now, if it hits 750, on top of that, it's going to sell your shares at 750 as well as the premium of 25 cents. So you're going to get around 775 instead of if you decided to sell your shares at 550. So that is what you could do. You could have also done like a $10 strike, but you're not going to get the further out of the money, the less you're going to get for the cover call that you're selling. But Zyne isn't really a good stock to do it with. Maybe something like Microsoft, which is a very expensive stock to own. But say you had like $100,000 in Microsoft shares, and that's like, I think that's like 10, close to 10 contracts. Okay, so you could do this for like, you could be here maybe, and you wanted to give out maybe until here. That's like 2 weeks. So maybe you would do like 115 strike, and you would get maybe like 75 to like $1.15 per contract. So you're gonna get like 750 to like $1,150 for all your contracts that you're selling the covered call. Now, the worst thing that can happen is it can sell your shares at $115, and that's more than it was here. So on top of the $115, you're going to get the premium of 75 cents to $1.50 or whatever the case it was going for that time. Now, if it goes below this, you're going to keep your shares at the end of the contract, and you'll just you didn't sell it at as high if it's right here, and it goes down here when the contract's over. So I hope this kind of cleared things up. I know it's extremely complex thing, and it takes a lot of brain power to wrap your head around everything, and it's not for your every investor. But in the future, it doesn't hurt to at least have a little bit of knowledge, because before I ended up, I'll tell you where it could have paid a lot of money and saved you. So as soon as September hit, there were some people, George Soros was selling his shares, and he's a big institutional owner, and so you have, say, $100,000 in your regular stocks, and you want to play the safe side. So if it goes down below this for the next 2 or 3 months, you're gonna collect some money on the downside. So they call it insurance. So say it's at 287, and you want to get 280 puts or 275 puts for this. So if you bought 1 or 2 contracts, and I don't know, they can be pretty expensive on the SPY, buying the contracts, but maybe like $2 to $5 per contract, so $250 to $500, and it was here on 280, let's say. As soon as it goes down to 240, you're getting $40 per contract. So you effectively like 10x to 20x your put, and this was your safety. So you're going to get money when it goes down. And if you just kept all your money in here, then it's going to go down, down, down. On top of that, you could use the mentality that, okay, this has gone down so much, I'm going to make calls now because I think it's going to go back up to 300 SPY. So you could do a 2 or 3 month call for 250, a little out of the money, and maybe to pay like $2 or $5, and then effectively turn that into another 20 to like 10 to 20x your money on that. Yeah, I mean, there's a lot of money to be made in option contracts if you're right in the right direction, but effectively you can lose a lot of money too. And that's why it helps to have a lot of time when you're buying calls or puts. And if you're selling calls, covered calls, then you just understand that effectively you could lose your shares at the end of the contract, but you're going to get a premium. And you could keep your shares for that time as well as getting a premium. So these are things that people need to think about, and I just wanted to do a video because on top of this, I think it helps you guys, but by me being able to explain things helps me better understand things so I can effectively have a better knowledge of the subject. So it's a win-win. I hope you like this video. Please hit the bell notification, subscribe, thumbs up. I like all that stuff, and share. And until next time, peace.